Warren Buffett is not your average billionaire. He's not interested in flashy cars or extravagant mansions. No, this man is all about the art of investing. Born in 1930, Buffett developed an early interest in money and investing. He started his journey as a businessman by delivering newspapers, and little did he know that this experience would shape his future as one of the most successful investors of our time. So now the question is, what's something we can learn from him? Welcome to Financial Literacy. Here, we are dedicated and passionate about bringing you nothing but honest and straightforward facts about your money. We will help you take control of your finances and get you to the next level. Beginners or experienced, this is your one-stop shop for all things financial literacy. In this video, we are going to give you valuable insights and practical lessons that you won't find anywhere else. We will dive down into the deep mind of Warren Buffett and see for yourselves the secrets behind his incredible success. So if you're ready, without further ado, let's start the video. One of the key pillars of Buffett's investment philosophy is value investing. He seeks out undervalued companies with strong fundamentals, aiming to buy them at a discount and hold them for the long term. This approach allows him to take advantage of market fluctuations and ignore short-term noise. Buffett's investment philosophy can be summed up in one word: value. He firmly believes in the concept of value investing, which involves identifying companies that are trading below their intrinsic value. In other words, Buffett looks for bargains in the stock market, companies that are undervalued and have the potential for future growth. But it's not just about finding cheap stocks. Buffett takes a long-term perspective when it comes to investing. He's not interested in making a quick buck by chasing the latest market trends. Instead, he focuses on owning high-quality companies with strong competitive advantages that can generate sustainable profits over time. Another crucial component of Buffett's strategy is his long-term outlook. Buffett takes a step back and considers the wider picture, while many investors get sucked into the craze of daily stock price fluctuations. He is a believer in the process of compounding, which he says will make his investments grow consistently over time. Additionally, for Buffett, quality is everything. He concentrates on businesses that have a long-lasting competitive advantage, which means they occupy a special place in their sector and routinely outperform rivals. A robust customer base, an outstanding business plan, or a well-known brand could all be examples of this advantage. Buffett is aware that making investments in high-quality businesses is similar to laying a solid foundation for success over the long haul. Warren Buffett's success goes beyond just making money. He has a set of guiding principles that he follows in both business and life. Patience and perseverance are two qualities that Buffett values highly. He understands that success doesn't happen overnight and is willing to wait for the right opportunities to come along. Another thing you can take away from Buffett is the value of owning up to mistakes. When he makes a poor choice, he doesn't hesitate to admit it. In fact, he views these instances as priceless teaching opportunities. Buffett also adheres to the values of ethical conduct and good business governance. He thinks that developing trust with shareholders and stakeholders requires honesty, integrity, and transparency. Ethical behavior is another key lesson we can take away from Buffett's approach. He firmly believes in conducting business with honesty and integrity. In a world where profit often takes precedence over principles, Buffett's commitment to ethical behavior stands out. He understands that true wealth is built on a foundation of trust and transparency. Financial statements play a critical part in understanding Warren Buffett's investing approach, which cannot be understated. Knowing a company's financial status, in Buffett's opinion, is like seeing into a crystal ball that foretells its future success. So let's examine Buffett's method for interpreting financial statistics and identify the main lessons. We'll start with balance sheets. Now, hold up. This page is like a treasure map that directs you to hidden riches. I know what you're thinking right now. Oh great, another sheet of numbers! But, according to Buffett, you can evaluate a company's financial health and development prospects by looking at its assets, liabilities, and equity. Look for companies with substantial cash reserves, little debt, and a favorable equity to liability ratio. These are the indications of a business that can withstand any adversity. Next, we move on to income statements. Ah, the sweet sound of profits! Buffett pays close attention to a company's revenue, expenses, and net income. He seeks businesses with consistent earnings growth, as this indicates a sustainable and profitable operation. Steer clear of wild fluctuations in earnings, my friend, for those can lead to sleepless nights and shattered dreams. Cash flow statements are the last thing we have. This could be compared to a business's blood supply. After all, money is what maintains the machinery. The cash from operations, investment, and financing activities of a corporation are the three areas on which Buffett focuses. He seeks out companies whose main operations generate sizable amounts of cash flow, which they prudently allocate to shareholder returns and growth. Watch for businesses with a track record of generating steady and growing cash flow. Alright, now that you know Warren Buffett's investment philosophy and key lessons, it's time to know how to apply these principles in your investing journey. It's not just about learning and imitating his process, but you have to understand it too and adapt to your circumstances. One of the things Warren Buffett really nails down is spotting companies that have a special edge over their competitors. So, you might be wondering, how do we go about doing that? Picture this. It's a bit like searching for a needle in a haystack, except this haystack is vast, and it's full of companies that are just so-so. To uncover the gems, you've got to dig deep into financial reports, study industry trends, and closely analyze how companies are performing. Think of it as channeling your inner Sherlock Holmes, but instead of solving crimes, you're unraveling the enigma of profitable investments. Once you have identified these magical companies, it's time to calculate the compounding annual rate of return. This may sound like a complicated mathematical equation, but trust me, it's not rocket science. It's more like basic arithmetic with a sprinkle of financial wizardry. You need to factor in variables like earnings growth, dividends, and the magical power of compounding. With a wave of a wand, or a few strokes on your calculator, you can estimate the potential returns over the long term. But wait, before you start dreaming of swimming in pools of cash, keep in mind that investing is not a guaranteed path to infinite wealth. Warren Buffett himself has had his fair share of mistakes and losses, so it's crucial to stay grounded and realistic. Investing is a marathon, not a sprint. It requires patience, discipline, and a healthy dose of skepticism. That's everything. Warren Buffett's investment wisdom is invaluable to both the seasoned investors and newcomers to the world of finance. By adopting his strategies to your current financial journey, you can proudly say that you will stand out among the rest. So go forth on your financial journey, and who knows, you might uncover a new secret to building your wealth empire. Thank you for watching. If you like this video, please don't forget to give a thumbs up, comment, and hit that notification bell so you don't miss out on our following videos.